but what about the gold miners? Aren't they far above their cost curve? So why do you think they're taking so long to take off?
Well, I mean, you're basically playing their margins, and gold hasn't really moved that much. So it's based off of their inputs versus what they can sell gold for. So the way I would play it, if it were me, I would play the physical metals and I would play royalty companies over the gold and silver mining companies at the
Hello and welcome to Capital Cosmos, everybody. Today we have another special guest on the show, a returning guest for the fourth time, Mr. Andy from Finding Value Finance. Andy, thanks for coming back, man.
Well, I appreciate it. Thanks for having me on.
Yeah, likewise. Before we get started, though, nothing in this video is financial advice. Neither Andy nor I are financial advisors. And if you enjoy these videos, you enjoy these interviews, be sure to hit the like and subscribe button. Comment down below. Let me know what you think. Do all the YouTube stuff I'm supposed to tell you to do. With that said, Andy, take us to what you're seeing in the market today. What are some of the major developments that you're witnessing, whether it be oil, whether it be with uranium, gold, interest rates, TNX, the 10-year is down. It's been actually falling fairly precipitously. The last few days was really interested in getting your thoughts there. So just kind of give us on a high level basis, what's really got your eye at the moment?
Yeah, so the yields dropping is one thing that has me very interested to see how sustainable this drop is in the interest rates. If we get a big move down or lower in interest rates, I think that will be very positive for precious metals, gold, silver, platinum, all of them. So I think gold, where it is located, it's sitting on top of basically a bunch of support, very close to all-time highs. If the market conditions swing around with interest rates coming back lower, if we see the yield curve uninvert, we could see a slowdown in the market, and I think that's going to be incredibly positive for gold. But it doesn't mean necessarily that we'll see the yield curve uninvert with 100% certainty. A lot of these things are difficult to nail right on the short term. So you kind of have to get some data before you can say, yep, this thing is definitely coming back down. One thing that you can look at is the housing starts. And I think it's really important to watch the housing starts, because if yields start to drop, you're going to see mortgage rates drop too. And if we see the housing starts kick back up, and again, guys, this is going to take months, not weeks or days. Over the next few months, you see housing starts to come up when mortgage rates go down. I would say that everything is still intact for an inflationary environment, for credit expansion, and we could see most likely the dollar drop with yields coming back down. I think it's all positive for commodities if the housing starts come back up. If the housing starts dip dramatically, if they drop and we see unemployment kick up and all that, we could see a slowdown in the market in, we'll say, the short to medium term, depending on what this looks like over the next few months. So looking at the markets, looking at risk reward, I think the physical metals, especially gold, looks very good, and silver in the markets, the physical metals. A lot of the times towards the back end of a business cycle, if this is a back end of the business cycle, which there's a lot of people could debate this. So towards the back end, physical gold does really well. It also does well during wave 3. So I think gold's going to do well either way. That's kind of where my thoughts are at.
Yeah, so I've actually pulled up the housing chart here. You can kind of see we peaked out here in early 2022, and we've been declining since. I know a large part of your thesis is the fact that we've underbuilt homes from this period down. What is it, 2008, all the way out until 2019. This kind of, if you kind of eyeball this, this is kind of your average here, around 1,500, right? And we've been severely,
14 million. or 1.4 million.
Oh
Sorry.
yeah, 14.
Is kind of like
14
the
million.
average. Yep.
So it looks like we're retracing back down to that average. So you're saying if housing starts keep coming down, that spells bad news for commodities and vice versa, right?
Yeah, because you're going to get a slowdown in the market if you lose the housing market, and there'll be unemployment from construction and all that other stuff. But I think we are very similar to like the year 2000. So if you were to look at the year 2000 on that the housing starts there, how it pulled on back. What they did is they had a slowdown in the market, 2000, 2001. It kind of slowed on down. You can see that recessionary move. Because there was a slowdown in the market, they lowered interest rates, and the housing market had very low inventory at that time. When they lowered it, they created all this, I'll call it crap loans, loaned a bunch, and created a housing boom. I think that the market conditions are still there for a housing boom. There's a bunch of people that want to buy homes, but it's unaffordable to them because of the interest rate. So I think they raised interest rates up, the affordability got hit, and that's why we see a slowdown in the housing starts, is due to the affordability. But those people still want to buy homes, they just can't afford it. Right. If interest rates come back down because there's a slowdown in the market, which could be a potential, we're going to see, I think, housing starts kick back up. And that's why I'm watching housing starts, because that's where a lot of your employment, on the margin employment, which is basically construction, that's where a lot of that unemployment comes from, is if it's from the housing starts dropping. So if we see it drop, I think that's where we could see a potential slowdown. Now, if rates come down and it goes up, I think we're going to see more inflation. And that's where Powell's going to stay higher for longer, because the way he's controlling inflation is by holding this housing starts down through high interest rates, through the affordability. So he's trapped here because he needs to hold the affordability at a really bad level, to keep inflation from coming into the system from the new homes being built and the new loans coming against it. But the thing is, if you look at the commercial bank, KRE ETF, it looks to me like that's just one big Livermore accumulation cylinder. And then if you look at XHB, which is the home builders, which mimics the KRE, it looks like those could both take off, because the home builders look very strong. And as these interest rates have dropped, we've seen home builders rip it here. And that's one of the things that I talked about with on the website and stuff. It's like, watch some of these home builders. They have really ripped it when the interest rates have fallen the past few days.
Isn't this a double top though?
Well, that's what a lot of people would say, but I don't think it's going to be a double top in terms of a long term. I think you can draw trend lines across, and maybe I can show you, if you want, I can take individual companies and show individual companies. You might have to let me share real quick.
Yep. Go ahead.
All right. So this is me share. I'm just going to share Leonard Corp and DR. So this is what I see. This is on logarithmic, long-term, back to the 1970s. You can see we had a massive bull market in home building. We had our big sell-off of 05 down to 09. And that's an important thing to think about, because the housing starts peaked in 05. The housing starts peaked in 05. It came back down. And then we had a bunch of inventory that was building in 05, 06, 07, and 08 before that crash. That was a housing market-led crash, deleveraging event. That's where a lot of people try to compare it to. In 2000, we had low housing starts and low inventory. They lowered interest rates, and the home builders ripped it from 2000 onward. That's that move here. Leonard Corp's I'm just using this as a large company with a bunch of data. There's your crash, and it started in 2005. Now, we're not seeing a topping here. We're seeing this probably going to reaccelerate to the upside for Leonard Corp, DR Horton. Those are the big home builders.
That's actually,
in my opinion, this is a breakout and then the retest.
Yeah,
this is the big move up.
looking at that candlestick for the current month, I mean, we're only 2 days in, 3 days into the month, and you've already got this huge green candlestick.
There it is for the weekly.
Oh, this is a weekly. Okay.
Because interest rates have fallen back. Yep.
Yep.
So I think, and there's other companies that we can look at too that look absolutely ridiculous. This is all the home builders here. They're all up 5% plus. Where I think we could get a run. Now here's KRE. KRE is the regional banking ETF. If you notice, this is, I'm going to take it off log. This is a Livermore accumulation cylinder. And we're putting in what could potentially be the bottom. The bottom of that is when interest rates were to come back. What that does for the banks is it relieves some pressure of losses off their bond holdings. And if the housing market can kick up, it's going to increase lending. So if I were to put, I'm going to put XHB, which is the home builder ETF, over this. What you're going to see is a very similar looking chart, which is XHB over KRE, which is the regional banks. And I know some people are going to say, oh, this is a double top. That's only a double top if interest rates were to just keep going and going and going. And I don't think that will be the necessary case. I think we'll go sideways, is my guess, if interest rates remain at a high level. But so I think watching regional banks, which is KRE, and watching XHB, you can gain a lot of information on where we could potentially go over the next few months or even years. I'm in the camp that this is going to go higher if interest rates pull on back. And then what's going to happen is Powell's going to have to raise rates again at some point if he relaxes rates in the short term, which the strong selling pressure on the 2-year and the 10-year, it may suggest that could potentially occur because they're all kind of selling off. Maybe he overdid it. So what would cause this to be overdone? All the stimulus that they did. So he pumped the system during an expansionary phase of real estate, which went to a level that was maybe unsustainable for the housing market. We pumped it too much, and then he's gonna come back, and then I think the housing market will kick off again, and it will still be inflationary.
So you mentioned gold as well. You mentioned physical metals as another theme that you're bullish on at the moment. Gold is sitting at about it's right at 2,000 at the time of this recording. In my opinion, gold has been very schizophrenic. It jumped all the way from $1,830 to $2,000 within the span of a month, and it's been kind of flirting between upper 1900s to lower 2000s for about a few weeks now. It doesn't really know where it wants to settle. So what's your take there?
Well, I think it's waiting for the market conditions for interest rates to come back down, which we're seeing, where gold is positioned. I think it's got good support underneath it with lots of upside potential and eventually no upside resistance. So if you're almost at all-time highs and you break into all-time highs, there's not much upside resistance. So gold's basically waiting for the right market conditions, which I think is coming right now, where if you get a slowdown in the market or if yields back off, gold's going to run. I think silver's going to run too, and they could run very large amounts. The gold and silver mining companies, they're still, I think, gathering themselves. A lot of them are below the cost curves in silver, where they are struggling quite bad where the price of silver's at. And whenever you get into a situation where you're underneath the higher cost producers of the cost curve, like if you were to look at some of the well-known silver producers, go look at their break-even points, $23, $22, $24. Yeah. Some of the new guys coming on, 25, 26, 27, 28, they're all up there, right? If I have a chance where gold's sitting on top of its pattern, the market conditions are changing into favorability because of interest rates might pull back for a while. And you can buy physical metals under the higher cost producers. that just seems like a no-brainer to me. It seems like I can go buy a bunch of physical underneath the higher cost producers' cost curves, and if the market conditions swing in my favor, I've got a bunch of upside with very little downside. So the gold and silver mining companies are struggling because the price of silver, I'm just focusing on silver here, isn't above their cost curve. That's why you see First Majestic and all these other ones struggling, because the cost is below their cost curve. They can't do anything.
But
They just lose money.
but aren't the
So yeah.
yeah, in the case of the silver miners, yes. But what about the gold miners? Aren't they far above their cost curve? So why do you think they're taking so long to take off?
Well, I mean, you're basically playing their margins, and gold hasn't really moved that much. So it's based off of their inputs versus what they can sell gold for. So the way I would play it, if it were me, I would play the physical metals and I would play royalty companies over the gold and silver mining companies at this time. There is some margin for the gold companies, but their costs have ballooned higher. So the price of gold hasn't gone up fast enough for their margins to increase, given their inflationary inputs. So their margins have contracted, but they still have margins on gold.
Right.
It could be a few $100, $300, 275, whatever, depends what company you're looking at. I think the opportunities, physical metals and royalties. That's what I would focus on with the least amount of risk. And everything in investing comes down to risk and reward. If you've got a low risk opportunity with high upside potential.
Yep.
Yeah. So yeah, that's GDX versus
Gold.
future
Yep.
gold
So
price.
this is, I mean, this is about as cheap as it's ever been, neglecting 2016. So, that's
Now this will do well if we see a if the environment or the conditions come into existence where the yield curve uninverts, this will light up. This will start to work its way on up, because gold and silver are going to go up and oil is going to remain. It could remain a little bit lower in the short term. But if the housing start to rip to the upside, which means more inflation is going to start coming, it's with a lag behind it, then I would just stay long and maybe perhaps watch this and accumulate this eventually if we start to see a positive movement in GDX or XAU or whatever gold and silver mining index you follow, or ETF. But I'd be watching this. I'd be watching it like a hawk.
Got it. Let's shift over to oil. Oil sitting at right at $80 just about. And just like gold, it's also been fairly schizo the last few weeks. What do you make of oil?
Well, I think oil is under pressure. I think so oil and interest rates are highly correlated. When interest rates go up, oil is generally either gone up already and interest rates kind of follow. It's the transmitter of inflation is what I'll call it. If the yield curve does uninvert, where the 2 and 10, if it comes back down, we could see some pressure in oil to the downside for the short term. And then what I am doing is I'm basically bullish on gold, because I think gold's going to go up, gold and silver. So I use that as like kind of like a big hedge in my portfolio. I don't want to dip out on the oil stocks. These oil can still go up even though the yield curve can uninvert. So I'm not saying it can't go up, but there could be pressure depending on how this market looks and how the housing starts kind of work its way out. So I'm remaining long. I'd still buy really good companies. The ETFs still look good. Like if you were to look at, and I guess I can share it, like XOP, it doesn't look bad. But I'm just saying short term, there could be some pressure. And XOP, I got it here. I mean, even right now, it still looks very good. We're right underneath resistance, and I'll back out and show you what I mean. We're underneath the neckline of a very big inverted head and shoulders. So that's a shoulder, a head, and a shoulder, and the neckline's right on top of it. We're just underneath the neckline. So very short term, yes, we could go down a little bit in crude oil. Yeah, okay. But I think if we see any sort of strength in oil, this could easily pop. And if it pops, I mean, we could see a big move in the oil and gas companies and in oil itself. I just don't know the timing on the short term. We want, because again, oil and interest rates very highly correlated. We're starting to see a little bit of weakness in interest rates. We could see a little bit of a pullback in oil, and then from there we'll see what happens. Like
Yeah.
we could get a big move higher.
Yeah, I like the
After
fact that
that
you
little
brought
pullback.
up the correlation between interest rates and oil. If you actually juxtapose the TNX on that chart or on an oil chart, I mean, they're pretty much like the same thing.
Yeah, they're highly correlated. Yep.
Yep.
Their movements are the same.
Maybe not the degree of movement, but the overall direction of the movements are very correlated.
Yeah, like from here onward, it's moving upward. We're just coming up into this resistance line. I think what I think people here, I'll go into this here real quick. I think people are too focused on the short term, and what they really need to focus on is the long term. And long term, these things are going to crush. Like they are going to crush it.